Hi, thanks so much for tuning in. We're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Today we're talking about the issue of replication or duplication when you're investing in equity mutual fund schemes. This is essentially a concept where you are investing in multiple schemes, but the portfolio looks a little alike. What are the problems that can arise out of this happening? And why is this not good for you? How do you reduce that instance, or how do you remove that instance is what we're going to be talking about right now. Joining me in studio is Harshvardhan Roongta, the co-founder of Roongta Securities. Thank you so much, Harsh, as always, for taking the time.
It's a pleasure being on the show, Alex.
So let's talk about this, because ultimately what a lot of investors that I've seen do is that they start SIPs or they invest in a scheme that looks good at the time, and then either they pause it or they shift their investments, and invariably they have a lot of schemes. And there is this issue of duplication. First, explain what duplication or replication is and why is it a bad thing?
So, Alex, invariably, if you look at investors, over a period of time, will keep accumulating certain schemes which they, which they listen to from their friends, or they look at past performance, and these performances are going to be cyclical. So, at one point in time, a particular scheme will be on the top of the charts. Probably 2 years later, you'll find something else, some other scheme being on the top of the charts. So, what an investor does is just keeps accumulating new and new schemes without realizing that most of them would possibly be doing the same thing. Well, you could have been in a better position to just have probably one scheme in a large cap, one in a mid cap, one in a small cap, and that should be good enough. But you would see people having like 2 schemes of large cap, then they'll have multiple schemes in mid caps, etc.
Or a flexi cap.
Absolutely. So, see, the idea is there is one data point which probably your advisor would have, your mutual fund distributor will have, or somebody will have that data which you can have access to, is a portfolio overlap ratios. So there are tools which help you compare 2 schemes and help you understand that if you're buying 2 different schemes, what are the number of common stocks that you have? What is the percentage of portfolio overlap? Now, if I may give you an example, we did just some bit of comparison in different categories. So if I just take a large cap category and I pick top 2 schemes by AUM, okay, the largest amount of AUM that the 2 schemes manage. So one is an ICICI approved blue chip fund and SBI blue chip fund.
Right.
If I just run a portfolio overlap, to understand what is the commonality between the 2, you'll find the percentage portfolio overlap. Okay,
in terms of assets under management.
In terms of AUM and
right.
in terms of the companies that they invested into, all that. So the percentage portfolio overlap in the large cap category between the 2 biggest schemes is 50%.
50%?
That's right. So if you were an investor putting your money in ICICI approved blue chip fund and SBI blue chip fund, your portfolio at the end of it will be similar to the extent of 50%. The number of common stocks, that is there, like both of the schemes are holding the same companies, is 24, which is approximately 60% of the companies that you're investing into through both these different schemes is the same. So are you really, what is it that you're really making, achieving by having 2 different schemes in the same category?
So a question here. So we've talked about 2 large cap schemes. Does this occur in the broader market schemes as well? Because one would assume with the universe being larger, the instances of that happening should be less?
So I'll give you 2 points, okay, on this. So one is, of course, we spoke about large caps. So we have a similar, data point for mid cap and similar data point for small caps.
Yeah.
So obviously, large caps being 100 companies, the overlap will be larger, will be higher.
Yeah, high.
And in a mid cap, because there are 150 stocks that come by definition of a mid cap, so the instance is a little lower. Small cap, the definition broadens further. So all 250 and beyond companies are small caps. Okay. The other point is, any fund house for that matter, so there are like about 40 plus AMCs, all fund houses, the first filter that they have is that they shortlist an investable universe.
Right.
So out of the 6,000-7,000 companies that are listed on stock markets, doesn't mean that they track and research all of them. So they shortlist that, and that list invariably is about 350 stocks.
Sure.
So every fund house for that matter will have on an average 350 stocks which is in their research list. Once they are in the research list, then their analysts are only picking the companies that you would want to invest out of these 350.
Based on whatever parameter they decide takes precedence. Is it growth at at an attractive valuation?
Correct.
Or is it value, or
Correct.
is it something else?
So they will have certain basic parameters on basis on which they've already shortlisted about 350 companies. Now within those 350 companies, they will allocate with all their different schemes.
Sure.
So large cap, mid cap, small cap, everything falls into this in those 350, 400 schemes that they may have shortlisted. Now coming back to our data points that we were talking about, the large cap, I said the portfolio overlap, percentage overlap is 50% and the common stocks is 60%. Now if I look at the mid cap, two large schemes of in the mid cap, HDFC mid cap opportunities and Kotak emerging equities. These are the largest AUMs in the mid cap space. The percentage portfolio overlap is 25%.
Okay.
Against a 50% in large cap. As I said, the universe of investing is 150 companies now.
Yeah.
Now the percentage of the number of common stocks is 40%.
Oh, okay.
So while the large cap had 60% common stocks, you heard the ratio comes down to 40%. In the small cap category, I mean the percentage portfolio overlap goes down further to 15%. And the number of common stocks is 16%.
Right.
So
but here you've looked at Nippon small cap
and the HDFC small cap.
Sure.
Again, just picked up the two largest schemes in the small cap in terms of AUM. Now the market that you said. So flexi cap, I pick up a flexi cap and compare it with a large cap because flexi cap invariably have a larger
tilted towards large
caps. So I take the largest scheme in that category, Parag Parikh Flexi Cap, and I compare it with ICICI Pru Blue Chip. The percentage portfolio overlap is 31%, and the number of common stocks is 50% again.
Wow. Okay.
So it would be somebody's allocating more to a particular stock and somebody's allocating less.
Yes.
So invariably, what an investor needs to understand, what are you really gaining by adding like 10, 15 schemes into your portfolio? Are you really getting anything extra?
So, but talk about the issue, and why is it an issue that you're investing in two schemes which are with a high degree of overlap? Why is it a problem?
Let me look at it the other way. What is it really that you're gaining? So why would you invest in two different schemes? One, you would want to take fund manager diversification to say at one point in time somebody will do better or somebody may not do better. Or the other thing would be a fund house diversification.
Sure.
You say I don't want to put everything in one fund house. So I don't think these arguments are really overweighing the disadvantages that you will have by having so many schemes in your portfolio. So you really need to see what you're doing. While you have so many different market segments and different types of schemes to invest into, so why not diversify across different segments? Like you have one large cap, one mid cap, probably one small cap. You have a different style of investing. Could be value-oriented investing. You could have some thematic sector. You could have international equities. Where there are so many other options available.
Or and to make the point on the flexi cap and the fact that it's large cap oriented, and here you're talking about PPFAS or Parag Parikh, and you're talking about a large cap scheme.
ICICI Blue Chip.
So, but in this instance, you would talk about investing in a Parag Parikh and then not having too large of a large cap fund allocation. Maybe you can look at a passive to shore up that percentage of large cap.
Absolutely. Right? So if you're taking a Parag Parikh Flexi Cap, which probably has about 70% or 80% odd in large caps. So it's a quasi large cap for you. So you might as well treat it as a large cap fund. Because in a large cap fund also, 80% has to go into large cap stocks and 20% it anyways go into any other, it could go into mid and small caps as well. So that's exactly what a Parag Parikh Flexi Cap is doing for you. Right? So why would you then need and your point on that if you really then still want a large cap fund, then go for an index fund.
Yes. Because the cost is less.
Absolutely. The cost is probably 1/10 of what an active fund would be. So why would you not do that? So that strategy still makes sense. But to have two active large caps in one portfolio doesn't make sense, quite honestly.
The other aspect that you have to bear in mind is, they say diversification is absolutely key. Is there such a thing as over-diversification? And this is now a little bit of a nuance to this conversation that we've had, which is having too many schemes and therefore too much of commonality in the schemes. But over diversification, having one in each category, is that also wrong? I guess it would result in this commonality.
So I say one in each category still makes sense.
Sure.
Because you're taking exposure to a large cap, you're taking an exposure to a mid cap segment, you're taking a small cap, or you're taking international, whatever you're doing. So that still makes sense. But to have 2 or 3 schemes in one category is a problem.
Okay.
Because it doesn't really serve any purpose. As I highlighted that in percentage of overlap, what is the point in having 2 different schemes of the same category? it doesn't really help you much. You just will have a huge list of schemes that you're investing into. Assume a situation where there is a capital gains. So you'll have to compute capital gains, file with all different fund houses. I mean, not file with them, but just you'll have to compute with all schemes separately, maintain documents. Imagine a situation, so the disadvantages of having too many schemes in your portfolio. So while you may say, suppose hypothetically 2 years down the line, you change your bank account. You'll have to manually go and update all your bank accounts with all the folios with all different fund houses. Unlike a central KYC, or CKYC that you do is once centrally you've updated your KYC details, which get updated with all the schemes that you have. But your redemption bank accounts and all that has to be done manually with all the fund houses.
That's a problem. That's a nightmare.
Imagine in case of demise of the unit holder, and then nominees have to go and fulfill all the documentation across all fund houses.
So more than anything, it's the practical problems or nightmares that you might have for having too many schemes.
So administrative discomfort and no real benefit.
Sure.
So I'm saying, so I'm okay to do an extra legwork with paperwork and all that bit if it gives me something in return.
Yeah.
But I'm just doing too much of paperwork, too much of administrative hassles, and then I'm not really getting anything in return of that.
The other aspect is in large cap funds, and to a certain extent in a couple of others, but mostly large cap actively managed schemes, is the issue of index hugging.
Yes.
And effectively what they're trying to do is protect the downside and to say that, okay, I'm not underperforming the benchmark in a big way, which has been an accusation that a lot of large cap fund managers have had to contend with. But at the same time, what are they offering you beyond just investing in the index? And they've not. So how do you pay attention to that? You obviously look at the fact sheet and look at what percentages are there, and if there is a substantial commonality, then you shouldn't be investing in the scheme.
So I'll tell you, I don't really blame the fund managers for this, because what do investors and what do anybody judging a performance doing? I mean, we're looking at benchmark, and you're saying that you haven't been able to beat your benchmark. If the markets have fallen, you've fallen more than the benchmark.
That's a problem.
So that is the reason they want to be along with the benchmark.
Yeah.
I don't really blame them, because that's what the industry or the market is asking them to do. You give the liberty to a fund manager to say that, okay, look, we don't bother about what you do, but why don't you take some divergent view, and why are you sticking only to the 30 Sensex stocks or the 50 Nifty? I mean, why don't you just do what you feel like doing?
So, but to that point, Harsh, large cap fund managers, if I look at 2024, and of course, the picture's changed entirely in 2025, but if you looked at it towards the end of 2024, a lot of large cap fund managers actually managed to beat the benchmark because they utilized that 20% window that they had, or that threshold that they had to invest in the broader markets, and they got that alpha. So there are people that said, okay, we're not going to go index hugging.
No. So index hugging would be that they would have stocks which are replicated, which are forming a part of the index, but their percentage allocation would be different. Okay. So when you take the number of common stocks percentage, that will be higher.
Okay.
But percentage of portfolio overlap in terms of AUM could be lower. So they'll have common stocks, but the allocations could be different. Now, when the markets have gone up and they've leveraged the 20% liberty that they have to go into mid and small caps, the investor is not that kind when the markets go down.
Yeah.
I mean, while it's going up, they say that, okay, fine, good, you've done a good job for us. But when the markets fall, and the markets have fallen, the index has fallen 10% and you've gone down 15%, they'll say that you've not performed well. So, I mean, we are ungrateful to the hard work of the fund managers, and we just put them in such a tight spot all the time that all the profit that you did was what because the market gave me. The losses are because of your wrongdoing. So we've been harsh to the fund managers. And so my point that I'm trying to drive is that everything that we've been benchmarking our decisions upon has not been the right thing. I mean, we've not looked at, when you see any retail investor, the only thing that they'll go online and see who's been the best performer.
Yeah, which is incorrect.
Which is not the way. I mean, that's
because
certainly not the way.
In certain time frames, you'll have the outperformance of a particular strategy.
So I'll enumerate this, if I may. So there was one fund house which had an exposure to, say, Kalyan Jewellers.
Sure.
Okay, they're heavy exposure to Kalyan Jewellers. When Kalyan Jewellers kept doing very well, they were on the top of the charts everywhere. So everybody, if you were looking at only those performance of the last 3 months and 6 months, I mean, you would feel that this scheme is the best that could anybody.
And a lot of people did go and invest in them.
And without looking into it, that what has been the reason?
Yeah.
Right. So and some fund managers just could be lucky. I mean, they've just invested into one particular company to the extent of say 5%.
It's taken off.
And it's just taken off that point in time. But that may not be a consistent. So we're in a marathon, right? We're not in a 100 meters race. So 100 meters race, you will have spurts where somebody will do very well But if that's my time horizon, no.
It's been insightful, educative as always. Thank you so much.
My pleasure, Alex.
Now let's move on.